All right, well, joining us now, Pepe from Shaw and Partners to start off what he's looking at in small caps at the moment. Phil, great to catch up with you again. Before we do a specific deep dive, how are you viewing the market at the moment?
Look, it's optimistic. We had a good week in the markets last week. We got off to a reasonable start today. It is still school holidays in a lot of the states across Australia, so volumes perhaps aren't what they normally are. But there's generally a level of positivity. I think the view that in some cases interest rates may have peaked. Some are of the view that there might be one more rate rise to come. But if interest rates have peaked, some of the growth stocks are now starting to rally, given that they tend to decline when interest rates have been rising. So I think quietly optimistic. There's also a view out there that perhaps we're moving a little bit too fast too soon with the high employment data last week suggests that perhaps costs aren't under control yet, particularly labour costs. And we've seen some companies report higher than expected costs because of the ability to access employees. And we might actually see that play through in the June company reporting season come August. But generally speaking, I think many are thinking sort of the worst are behind us in terms of financial shocks anyway, and hopefully it's onwards and upwards from here. So quietly optimistic, I would say.
All right. Well, Phil, let's get into it. And you there at Shaw and Partners have initiated coverage on Acrow Formwork and Construction Services with a buy recommendation, I might add. Just talk us through your thesis here. Interesting, because if we do get a slowdown in the Australian economy, I would have thought this would perhaps be a negative for Acrow.
Sure. So, I mean, that is a common misconception in the market. So we initiated on this stock last year, and it's actually performed very well. A colleague of mine covers it. But the contradictory view, or the reason why we, and I personally also disagree with that view, is that we're very much in the stronger for longer space in terms of the segment. So Acrow operates in the engineering and construction space. And if you look at the industry data, there's still forecast 200 billion per annum to be spent on construction projects in Australia per annum for the next 3 to 5 years. Now, it is forecast to grow to a peak and then come off. But our view and my view is that, well, in order for that to come true, we need the labour to be able to do the work, and we're still struggling to get the labour. Again, you saw the employment data last week, and even with immigration returning, we still don't have enough labour to do the project. So our view is stronger for longer, and a lot of these are major infrastructure projects, either government funded or funded. They just need to be built, like bridges and tunnels that needs to be spent. So we don't think, even if there's a slowdown in the economy, you're not going to leave a road half built or a tunnel half built or a bridge half built. They will be completed over the next 3 to 5 years. You might get weather slowing things down, but that often means more spending. So for us, most people should consider having an exposure to the engineering construction space, because it is relatively safe compared to other sectors, given the solid outlook for the sector for multiple years, not just the next 12 months.
If we get up the share price, if we can, is an impressive looking chart, certainly over the past 12 months. You initially had a price target there, 85 cents. Have you stuck to that?
No, analyst has upgraded. It was a very strong first half result. Our price target's been lifted to $1.05. So very, very solid first half results delivered by the company. They delivered sales growth of 14%. Profit growth of 52%, that's reported or underlying profit, and cash profit up 63%. And they also increased their guidance for the full year. So company delivering very well. So in terms of what it does, to oversimplify it, they sell formwork and support work for building construction. So when you see a construction site, you see all the steel forms that the concrete gets poured into, and all the scaffolding that people walk up and down. That part of their business is in high demand, particularly their formwork, which was up 34% for the first half. So a lot of these projects are becoming more and more complex. They need more specialists, they need expertise, they need engineering input into terms of supplying the scaffolding and supplying the formwork. And their products and services are in high demand. So as I said earlier, the more we spend on this project, the more you need Acrow's services, and you're not going to leave a road half built just because interest rates rise or because the economy starts to slow. So Crackerville first half result, increased guidance. Channel checking suggests that there's a lot of work still to be completed in the next 12 months that they're currently working on. In terms of some of their projects, they have a pretty good success rate in terms of tendering. I think they've got an order book of over 100 mil, and they're winning about 1 in every 2 projects that they're tendering on in terms of their area of expertise. So we've upgraded our price targets since initiating, because the company's beat our expectations, but also they've actually increased their guidance and painted a pretty positive picture for the next, certainly for the next 6 months, but we think for the next 2 to 3 years as a minimum.
Yeah, I guess further to your point, Phil, you only have to look around cityscapes at the moment to see construction under work with all that formwork that goes with it. So I take your point. I note also in Shaw's research note that you're talking about entering that underpenetrated and a less competitive market. What is meant by that?
This is still, I would say, a growing industry. So Acrow does very well in Queensland, and it's growing in New South Wales and starting to grow its market share. It's also made some recent acquisitions that gives it extra products to offer. So there's different. Again, I'm not an engineer, but there's different types of scaffolding, for example. There's high rise, there's lower level stuff, there's screening. So they've made some acquisitions recently that give them an extra products they can sell, and because of the specialty of what they offer, there's no off-the-shelf product. So it's not competitive in the sense that if a construction company goes out the tender, there isn't 5 off-the-shelf products that they can buy. The stuff often needs to be tailored to the project, and because of that, they often can get price increases put through or charge for the value add. I think the contribution margins are 70%, 70 in terms of what they do. So as you think of the Snowy Hydro project, for example, that they're tendering on, there is no off-the-shelf product that the project can build to insert. It needs to be custom made. So that's kind of new areas, growth areas that aren't overly penetrated, that they can actually show their capability and grow into. So we really like what they're doing. Their results speak for themselves. Their guidance has been upgraded. I think they're on track for a record year, again underpinned by 200 billion per annum spent on construction just in Australia. We think it's a very positive outlook for multiple years. In terms of just to highlight a couple of things, based on consensus, so not just the Shaw forecast, but consensus has revenue growth of 35% over the next 2 years, and profit doubling over that period of time. So a company expected to double profit over 2 years. And it's trading on single-digit PE. It's on about 7 times PE. Competitors or peer groups are on about 12 times. So the opportunity to buy a company that could double its profit over the 2-year period to June 24, trading in a single-digit PE and pays a dividend, partially franked. For us, that's a compelling buy opportunity that isn't going to go away because of interest rate rises or because of rising unemployment in Australia. We quite like the sector and we quite like the stock.